I got cheese
in
curds.
the group, I presume?
No, I just have my personal page.
Okay.
Because then I can share it to the group and I can share it out to Facebook like
Yeah,
live.
so he's,
And I'm just talking and I'm live. Yes. All right.
So we're having some juice for
Yes, we have sound.
It's not coming from the mic though.
You don't think so? What? Hello? It's just general? Hold on. Hold on. That might be better. I don't think it was plugged in all the way. It was? It definitely wasn't. Now you can hear me? Yes. It's so unprofessional. All right, guys. I'm officially live, just so you know. Liz, you're going to continue that later. All right, everybody. So I was asking earlier this year, what do people want to learn about this year at the Huddle? And I don't remember who said it, but somebody said lease options. And then Mr. was like, I can help with that. And I was like, great, we're going to schedule you a date to come teach on lease options. So that's literally how we got to this point. So we're live. We're back in Oso. Hopefully sound is better now. All this is hooked up. So Mr. is going to stand here. If anybody has any questions, I will be watching this feed questions on my cell phone in the back of the room. So if anybody online has questions, reach out to me. I know my sister was freaking out, like, I met him. I want to see his feed. So Michelle, if you're not watching, get your ass at the computer. Okay, that was it. That was a good intro? Yes? All right. Everybody enjoy your food. I'm so happy to be here. Mr. Oh, look, see, Deepa already said hi. See, you'll be able to actually see comments, which might totally be weird while you're speaking. Okay, everyone, we're live on Facebook right now. Yeah. So, everyone, please welcome Mr.
All right. So it was really half-fast with me getting on here, but I'm excited to be here. You guys all do a lot of different things. So I know I got a couple flippers. Who else is flipping? Okay, wholesalers? Ish, yeah, okay. Once in a while, okay. Buy and hold people? Anybody buy and hold? Okay. And then anybody just raising money, private capital, like hard money? Okay, cool. So I went through and it's all like predicated on Mr. John Burley, and he's based out of here in Scottsdale, Arizona. And I've been going through a lot of his stuff, and I will tell you that my mind and my entire like philosophy on real estate has changed. I've done a lot of different things in real estate, both going from wholesaling and fix and flips to Airbnbs and short-term rentals. Even now, I'm like building software for property analysis and market evaluation. So I got really nitty-gritty on the analysis paralysis side of things. That is not the case here. On the lease option model, it's actually, one of the ways that it changed for me was it's nothing that we're used to if we are just thinking real estate. When we're raising capital, we don't actually talk about real estate for the beginning portion of the conversation. And if we have to, then I'll draw a house and we'll go through that portion of it. But raising capital, actually, I don't know if you guys have noticed this, but real estate really doesn't have anything to do with real estate. It's kind of just a byproduct as the vehicle that we're using to either make money or make cash flow or whatever the case. Real estate is just an asset class, and you can do kind of the same thing with any other asset class. Does that make sense? And so that's kind of the shift in mentality in that portion. So I'll talk about a little bit about how the conversation of raising money that we do, and then also how we kind of structure the lease option model based on that. So raising money wise, who likes raising money? Is it fun? Yes, perfect. For those who don't, why don't you like it? Is there? It's a pain in the ass. Okay. How? Why? Because I have more fun going and finding the deals. Yeah, that's fair. Anybody else that doesn't like raising money? Why?
Because the most money you raise, you gotta pay it back.
Okay, so how so? What do you mean?
Like you're normally raising capital, like you're borrowing it.
Like hard money or private money or rate of return type situation? Okay. And so So when you say pay it back, are you mad about it because you made money in the process?
You're right. I'm not mad at that part.
Right? So did it actually cost you anything?
True.
Right? And so that's kind of, taking a different ideation on how to approach this entire thing. It was kind of a mental shift for me because I'm used to that too, right? Like, and I don't like paying interest, period. And that's not something that I do. But even now, we were talking recently, and the way we've structured everything, the way John Burley kind of has everything set up, made 100% sense to me, because especially when we're thinking about paying back, we're thinking about short-term capital, right? Whether it's 3 months, 6 months, a year even, that's still technically short-term in the big scheme of things, because mortgages, we're looking at 30 years at that point, right? So a year is still technically short-term. And so when I, go through and have presentations with investors, they're technically not real estate people. Majority of the time, it's going to be other business owners, doctors, engineers, people that don't have the time to learn real estate. They need to figure out a different alternate because they don't have the time to make more money. They need something else to make more money, and money's a great vehicle to make more money. Does that make sense? So as far as our presentation goes, when I sit down with an investor, I try to figure out what's important to them. And usually that conversation has nothing to do with money. It's usually about, number one, safety. Do you guys agree that safety is kind of important to you when you guys are doing an investment, right? Like, when anybody do a deal or do an investment that they didn't feel safe on, how does it feel? It's not fun, right? It sucks. It's the worst, right? And so that's usually how most people feel when they're thinking about investing, whether it's real estate, stocks, crypto. Safety is kind of like a pertinent thing. If they're using 401k money or pension money or IRA or whatever the case, they want it to be safe. Secondary aspect of it is security. So safe and secure are, I think, two different things. Security just kind of gives you that bubble feeling, knowing that there's other options available. There's something that we can do regardless of what might happen, like a COVID, for example, right? What else is important? Are we looking for long term? Are we looking for cash flow? Are we looking for ROI? That's when we start getting into the numbers or looking at the real estate side of things. But that's literally like talking point 5, 6, and 7. Does that make sense? So we're looking for safety, security, long term. Those are kind of my 3 main talking points that I hit almost every time, because that's usually what people want. If it's 401k money, they're not living off of it, right? If it's IRA money, they're not living off of it, but they are only making 4, 5, 6%, and so they need something safe, they need something secure, they need something long term, and that's a totally different conversation than doing a 6-month hard money loan. Does that make sense? I also like to tell my clients, you know what? I want you to make one decision once and feel safe, secure, and have a long-term decision, because you don't want to have a hard money lender situation where you're making a decision every 6 months or every 3 months trying to place that capital and make that return back. Does that kind of make sense as far as the difference goes? So now switching over to the actual lease term or lease option term and model. Who here has heard of lease options previously? Okay. How do you think that they work, or what do you like about them? What do you not like about them? And I know you and I just talked about it recently as well. So we were talking about a house in the Midwest that's $30K, and sometimes the lease options don't work in that regard. Definitely a different price point than here in Phoenix. Anybody else? Lease options, what kind of experience have you guys had with it? Fair. Tax advantages, yeah, absolutely, right? And I didn't even get to that talking point, but yeah, that's another advantage is taxes. One of the things that caught my attention for lease options was I think I realized that this structure took away most of the problems that we generally have to face in real estate. For example, flippers. Rehab, when you open up a wall, is it fun when you find something else behind it, right? It's generally not the case because it adds to your rehab budget at that point, right? So on the lease option model, we don't do a lot of rehab. It's kind of, a bare minimum, if that, because technically we're putting homeowners into the home. why would we rehab and pick your daughter's wall color, right? You can do that. It's your home. And so rehab is very minimal in that regard. For buy and hold investors, what's property management like? Are they fun to deal with most of the time? Yeah. Why is that? They're completely adversarial because they don't make money technically on your 10% fee. They're making money on the fees. They're making money on the calls. They're making money on turnovers. They're making money on the spread of rehab after a turnover, whatever the case. That's adversarial to you as an investor, to how you want to make money versus how do they want to make money. Does that make sense? And lease options, well, I'm putting the homeowner in the home. It's your toilet. Have fun, right? You don't have to call me because you're not going to call Bank of America the same way. You know what I mean? So it takes away that property management piece of it, but also not just the problem of it, but it adds to your bottom line because you also don't necessarily have to pay a property manager in that regard. Yeah, people are getting food. There's some, yeah, can you guys hear good? Okay, cool. Ooh. Trisha's watching, I see her. I told you guys I'll draw the house. I don't know what this was. This is a sidewalk. Let's make that the sidewalk. If I oh, those look good. Just doorknob. Oh, the door right here. Okay, I got you. All right, so yeah. So we'll play this game on an example here. Let's take a purchase price of $400,000.
Which is typical in Phoenix.
Yeah, that's about right.
I should probably, yeah, you guys can see that. Okay, cool. So let me backtrack then. To that point, is it still that cheap? So what kind of houses are ideal for a lease option? That's a great segment of conversation, right? And so one of the ways that he says it is it's middle of the road neighborhoods, middle of the road people. If there's any type of running in the neighborhood, it's either too bad or too nice. Because if people are running with purses and bags, then it's too bad. And if people are jogging, it's too nice. We want normal people in normal neighborhoods. Does that make sense? We want.
You got a rubber.
So yeah. But that's one way to figure out what kind of neighborhood we want to be in, like a normal B-class neighborhood where people are normal working class citizens, right? That kind of defines where our price point is based on what market we're at. So anything kind of near 10 to 15% of the medium income or medium house pricing in that regard. So here, yeah, I would say 400 seems about right. When you get down under 300, then we're kind of losing track there unless you find you're finding good wholesale deals. But anything under 250, now it's a whole different C-class market at that point. Here, yeah, something like that. And so we also don't want to deal with A-class properties. That's a whole different market. There's a whole different mentality of people and the buyers that are there. It's a whole different philosophy and everything else with it, right? And so we want normal people in normal houses in normal neighborhoods. They might still lease option because they might be cash heavy and credit poor. So they need to be there, but is that A-class mentality the same?
There's less of those around.
Yeah, there's also less of those around. But they're going to be most likely really high maintenance as well. And so that changes in philosophy on how they approach the entire thing to begin with. And then on top of that, a lot smaller market of buyers and pool of buyers at that point. So that's where, we'll stick with a 400, kind of right in the middle. Maybe it's a little bit high on that end, but the market. So if I gave this talk probably a month later, it'll probably be right on point. But on a $400,000 house, down payment, we're looking at what, 80K? And then PITI is right around 2,000. Don't want to check that. I'll check that too.
Just let
It's
everybody
close.
know what PITI is, just in case there's somebody listening that doesn't know.
Principal, insurance, taxes, and interest, or principal and interest, taxes, and insurance. They're all in there. It's all part of it. So right at 2,000. On a $2,000 property, or on a $400,000 property, rents could anywhere be right around $3,000 at that point. Rent is a little bit different if you have the ability to purchase the home. Does that make sense? So now you are no longer a traditional renter, because the lease option, you have the option to buy, which makes you now the homeowner. That additional option allows you to put in an additional premium, both on the front end as far as deposits and down payments go, but also on the rental side as far as the payment on the monthly. Does that make sense? Because at the end of the day, you'll have the option to purchase that property. So now, just paying for that option alone, above and beyond the market rent. What did I have?
Does any portion of the rent go towards the purchase price?
No. The question was, does any portion of the rent go towards the purchase price? And no, it does not. Neither does down payment or the security deposit or anything else. They're completely separate. So even the paperwork is actually separated. So the lease is one set of paperwork, and then the option to buy is a whole separate set of paperwork, and they're separate. So yeah, great question. So on a rent, we're looking at $3,500 a month. If we're at $2,000 for our PITI, which is our expense, we're looking at $1,500 a month. $1,500 a month. Let's do that by 12. What is that? 18,000? Yeah. Solid deal so far, right? Just that alone, if we're looking at traditional rentals versus a lease option, that number is pretty stellar for $18,000 a year. How we set it up, so when I talk to my investors, there's two levels to this. Number one, there's the cost of doing business with me to begin with. So all of my investors, they pay a $10,000 acquisition fee. So that's for me to sit at the table and sit on my computer and go do this for them to begin with. That's upfront, because anybody have a financial advisor or like a what is it? Stocks, yeah, CPA or something like that. Are they taking their money up front? 100%, right? If someone's going to go invest for you, 100%, right? And so that's where that is in the real estate world for me, is $10K just for me to sit at the table and make you money. That's what you're going to pay me for. We also do $5K for a reserve for the home. So those two things are just the cost of doing business alone. That won't come into what our returns are looking like or anything like that, because technically Wall Street doesn't take these into consideration when you're looking at your rate of return either. And so if we're going to play a Wall Street game, this is an easy conversation to have, because we're going to do apples to apples. If we're looking at now, we have this $80K down payment. Closing costs, we'll put about $12K. Now, if it's going to be somebody else's house, how much repairs do we need to do? As little as possible, right? And so maybe a little bit cleanup, making sure that it's livable. So, you know, when we're looking for deals from wholesalers or anything like that, we're making sure that the big ticket items are taken care of. You know, roof, AC, plumbing, electricity, like those are the main situations. But anything lipstick, cool, go with it. Because paint, flooring, anything like that, they're going to change it. And actually, I had a house that we did as a flip, and I remember we sold it, and the day after I went to go drop off the little garage opener, and they were ripping out the carpet. So I'm like, yeah, lesson learned, because you know what? My choice of carpet is not their choice of carpet. Does that make sense? So yeah, as far as repairs go, we won't put any. We'll assume that at $400K if we're buying this house, because a lot of these homes we can buy off of MLS. And so off of MLS, they're already rent ready. They're not necessarily needing a lot of rehab in that regard. So we won't do any rehab for that aspect of it.
Okay, so wait a minute, I have a quick question.
Sure.
So you seriously, you won't do anything, you won't fix up the house because you give them that option, obviously, to go and do what they want in there because it's going to be there. So
Yeah. Because if it's bad carpet in there, what are we going to write on the ad?
right.
It's a carpet special, right? It's a carpenter special. If it's bad paint in there, what are we going to write on the ad? It's a painter special, because these are normal working class families that have those types of people, because that's what they do for a living anyway.
So you won't fix it up that way at all, but if it's electrical, plumbing,
Then we'll take a look at it. Yep. Anything that's livable. So yeah, if the AC is not working in Arizona, yeah, that's a problem. We'll have to take care of that, right? Electrical, roof, anything like that, like major situations, because we're making long-term investments, right? And so those are things that we want to be able to address in the long-term aspect of things anyway. Anything beyond those big ticket items technically are short-term, and essentially are duties of the homeowner at that point.
What about like the actual like countertops, appliances? Not talking about just carpet paint, but like they're
Livable. Nope.
it's
Yep.
fine.
It's not my problem. Because it's theirs. It's their home, right? And so if you were going to go buy a new home, you would do that anyway yourself.
Do you
So
have to provide all the appliances?
no, you don't have to. And for the most part, they're going to buy their own anyway. So appliances and countertops and what that looks like.
Yeah, I didn't know if you have to provide all the appliances or if
I think just a stove and like
Yeah, what the necessities are.
for like a regular.
Yeah, exactly.
You can buy their own fridge.
But keep in mind that they're homeowners now. They're not just renters. And so even in the selling process, come to the house, take a look around. Can you afford the down payment? Can you afford the monthly? Do you want the house? Those are the three questions. Anything outside of that is irrelevant to me. Does that make sense?
okay, so when you use the word down payment though, if we're buying it and the lease option makes sense, so are they not getting a down payment, they're getting an option fee?
No, they will be paying a down payment. So the option fee is, or the executing the option is later, right? And so we'll do a 5, 7, or 10-year option, and that happens later. But up front, they're paying a down payment just to have.
For the purchase price?
Nope.
But you're still calling it down payment?
Yep. Or a deposit. Yeah.
So it's different than the option fee.
Correct.
So the deposit's then just renting it, right? So you've got the rental contract, they're gonna commit with the rent and the deposit to rent it.
Mhm.
And then they're gonna do the option and the option purchase.
Mhm.
To purchase the option.
Wait. One more time.
So you've got your rental contract, they're coming in with their deposit for the rent, right?
Right.
So if it's $3,500, they're coming in with like, I don't know, $7,000.
Yeah. So we'll do for a house like this, we'll do 4,900 down, and then we'll do first month is 3,500, and then we'll maybe do a $500 security deposit.
So that's what you're terming as the down payment.
Correct. For them to get into the home.
Not go towards the purchase price of the house.
Correct.
So that's the rental deposit.
Correct.
Okay.
See another hand?
So, in this situation,
Mhm.
there's no credit check, right?
We still do a credit check. Yep, we still do a credit check. We call it a easy qual. So what he told me was, even before, they used to do like no qualification. Then they realized if they write no qualification, then they're not even allowed to check for IDs. And so they made it easy qualification. But yes, we do still check credit. We'll still call references. We'll call landlords, anything like that, previous landlords or anything like that. So they still have to go through a traditional like application process, and then they still have to kind of get approved in that regard. You have another question?
Yeah, I think I missed it, but how did you come up with the 4,900?
Standard. It changes based on the market, based on that purchase price. So if we're in a market that's 200,000, then this might go down to 3,900. If we're in a market that's less than that, it might go down to 2,900. But this is kind of the standard down payment rate that we've been going with in that regard.
But on your down payment, you can ask whatever you want.
Technically. Yeah, technically. It just has to be, it doesn't even have to be reasonable, but we want people to be able to afford to get in there. But technically, if they don't have this money up front, then they don't necessarily aren't prepared to be a homeowner to begin with.
Because that 400K, you're typically around your middle class. What do you want to see? Around the middle class, right? For 400K, because anything below there, between your like 250, 300,000 is your Section 8 kind of housing.
Yeah, anything 250 and under, I'd say. Yeah, exactly. So you're right in the B neighborhoods. Yep, absolutely.
So, Mr. I have heard people talk about an option fee, but you're not showing an option fee. So I
No.
is that down payment kind of the same thing? Because like I've heard people call it like a non-refundable option fee.
Yeah.
That's what gives them the option to buy it at the later date. Or do you
So
have
the
some
contracts
fee?
basically take care of that because there's two separate contracts as far as the actual lease and then the option to buy. The reason that they don't mix the two is because it gets construed as a sale at that point, and that changes the tax benefit. That changes what you're able to do, especially when you're dealing with subject to or seller financing or things like that. That changes all of it, and so that's why we have it as complete separate things, and none of this stuff goes towards the purchase price of the option. Does that make sense? And so they're totally two separate ordeals altogether in that regard.
So this is also like in the lease paperwork.
Exactly. Yep.
Okay.
You had a question as well. As far as the buyer, regular people, regular homes, regular neighborhoods, working class citizens that need a home that might be, if they can't qualify, especially with FHA right now, they're based on appraisals, and are we selling at market price right now? No. So FHA, they're getting shut down left and right. So people feel like they can't buy a home. They'll never be a homeowner unless this kind of situation arises, because they're getting beat up left and right at that point. Not just FHA, but people that have poor credit as well. So, if they have a 600, 580, now we're kind of coming to the threshold of FHA. And so, yeah, those are exactly the type of people that are in normal neighborhoods, normal people that are looking to have their forever home and be there for the rest of their lives, but they just are getting shut down left and right.
Would it be wise to offer some sort of credit repair?
Yes and no, but now you're mingling your interest for the person that's in there versus your interest to the investment side of things. So that's the only reason they don't do it that way, because I asked that same question. So yes, you're giving them technically that time frame between the option. That's the time frame that they need to prepare themselves to purchase the home, because otherwise they would have never had that option to begin with. Does that make sense? Was there another question?
Well, I just wanted to say one
Yeah.
thing. We were just this interruption with us, but it's not just like for my husband and I, we were self-employed for a tremendous amount of time.
Yeah?
We didn't necessarily qualify for loans, for standard loans, conventional loans, because it's just and so that's what you were saying. Eddie doesn't, but Elda does, but that's why else. It's sure you can be Class B, but that's why this is great. Go for that model, but it can go for anything because people don't necessarily have the paperwork and the stuff that a conventional loan wants
Right.
to have, and they can still do that. So there's still good. There's still options out there.
Yeah, and to that point of, A-class properties, there's still people in the neighborhoods that are in A-class neighborhoods that have the money but are self-employed or whatever the case, that they need a different type of avenue to get to it. Does that make sense?
The time frame you're writing these in?
5, 7, or 10 years.
Oh, okay, that's it. Okay, one more thing.
Sure.
That Elwood just asked about, the difference between a lease option and a lease to own.
Same thing, just
So, but a lease
in a rent to own, it's kind of the same principle.
If some of the money every month is going towards the purchase price of that home, isn't that a little stickier than
Well, so that's different because technically that changes the legal aspect of things, because now you're mixing the two, and it's counted as a construed sale. When I do it this way, this sale doesn't happen until 10 years from now. Does that make sense?
Yeah, so that's what I wanted to.
Yeah. So technically, there's no home being sold today, but when they exercise that option, now it's being sold. And that's also why we don't mix the rent money with the option to buy money, essentially.
Wasn't there a law that came into
Dodd-Frank.
place that the Dodd-Frank?
Yep.
So Liz, with Dodd-Frank, that's when it came in that if you keep them separate. There
Right.
used to be a
That was
lot more rent-to-own or lease option programs where part of your monthly rent every month went towards the future purchase price of the home, or your down payment now went towards the future. You were, like she's saying, you were commingling this lease and the purchase at the same time and mixing them together. When the Dodd-Frank Act came after all the craziness that happened in 2008 and all that stuff, they were like, no, you can't do that anymore. They're two separate things.
Right.
And treat them as two separate things, or you're gonna get into some shit.
So
When the time comes, she purchase the house.
one more time. When the time?
Time to purchase.
How did you determine the price? Great question. Easiest way that we've been doing it, technically, the open answer is make it what you want. You can literally make up the number. The easiest way is we think about what the appreciation rate is generally at, so 3%, 4%, and we can bump that up to the whatever option time frame that we're going with. But technically, you can make it whatever you want, and the reason I say it that way is because that's where a lot of the predatory situations happen, right? And so technically, I can say, hey, you would never have the option to buy, so this $400,000 house, let's say in 10 years, you're going to pay me $800,000. And if you want to take it, you can take it. But that's my game to play, right? But that's where those predatory situations come into play. And so that's why we take an average of the appreciation. And let's say, like, cool, would you agree that 3% is an average appreciation rate? And let's just go with that number. And there's a risk both ways. Keep that in mind, because imagine 10 years ago, so I haven't had an option buyout yet, right? But if I had one 10 years ago and they were going to buy out today, would you guys agree that there's probably a spread that they're going to be able to make on that house? Right? Like
Nobody expected a 30%.
nobody expected a 30%. So the question at that point is, are we putting ourselves at risk by not being able to capture that equity? Well, technically, we've already captured our equity, and we've already had all of our advantages all up front built in, that it's almost an advantage for them to have that equity, right? Like, it's a win-win-win scenario at that point, and so I'm all for it. So if you can make an extra $100,000 because the market appreciated by 30%, cool. Like, that's no problem to me at that point.
So you're not predetermining the price.
We are. Up front, day one.
If it's 400 and I'm going to buy it in 5 years, you're going to give me a price of
Yeah, for maybe 3% a year. Yeah, 3% appreciation.
That's where
That's where I can sleep at night, right? And so, like, again, going back to, you can technically make up your price. Yeah, 3%, 4%, depending on the area. Correct. Yep. In the option contract to buy, yes. Correct. Question? I feel like I missed one. Okay. So now let's.
Sleep at night at 5%, Liz, just so you know. Just in today's market.
literally what you just said was that's exactly what's happening right now with this business. This business model is phenomenal. But who knew it was going to go up to 33%? So now you want to hope your homeowner doesn't take the option. But if they're smart enough to, because they realize, oh my God, I just made bank, then they should. But again, it just depends on with their knowledge and whatever else.
Well, and where is your heart in the right place, right? And so,
I mean, it's not going to go 33% every year, so
Yeah.
we're all going to come back to a level of normalcy.
right, and so I always say, like, it does go back to, you know, integrity, right, and honesty, because to be honest, we can play, as real estate investors, we can play whatever game we want. It's our game, right? But to have integrity in the game and being able to still make win-win-win scenarios, that's really where we're able to grow our business with being able to sleep at night in that regard.
Can somebody do a lease option, execute the option, but then put it on the market, sell it, do a double close, pay you, take
Yeah,
the cash?
yeah, absolutely. Yeah, absolutely. And it could be a wholesale deal or whatever, because technically, yeah, it's their option at that point, yeah.
However it gets executed.
So what I did here was I took this 92K, which is this part here. So this was 92K. This upfront money from the seller, or from the buyer, sorry, was 8,900. It's supposed to be 83 and 83,100. I just rounded to 83, so I rounded down. That is the total money in, because we would have gotten this as soon as we got a resident in there, right? Does that make sense? You guys follow? Okay, cool. So then as far as coming up with our rate of return, we're at $18,000 a year divided by 83. 18,000 divided by 83,000. You gotta be smarter than the pen. There we go. It popped out of there. I'm too strong. What did I do? 21. Technically, it's 21.6%. I'm still rounding down, but 21% for first year cash on cash is pretty stellar, right? Like, and I've only talked about cash flow. I've not talked about tax advantages. I've not talked about appreciation. I've not talked about depreciation. I haven't gotten into any of that other stuff, which if you're going to go compare to Wall Street, they're going to throw all of that stuff in the game, and I'm already pretty much catching up to them. Does that make sense? So now talking about raising money, again, I do a 10K fee up front. All of this is 50-50. So I can do this all day long for any investor that wants to play the game. They need to put up cash and credit, so they'll put up 92K for me to pull this through. They'll put up the lending for the 400, and I'll go find the property. I'll go manage the deal. I'll go deal with the paperwork. I'll go find the residents, and we get to sleep at night with 10% cash on cash for the rest of our lives at that point. Does that kind of make sense? So to your point of paying back lenders at 8%, whatever the case, would you be okay giving them 50% of something that you've never spent $1 on? Yeah, my point, right? Yeah, my point. So how many of these would you want to do at that point? And at that same token, how easy is it to have a conversation with somebody that can't make 10%? They're making 5, 6, 7% with, you know, stocks, bonds, or mutual funds. But now I can say, hey, listen, here's the property that you can drive by, own, and have, and now you have that safety, security, long-term cash flow. Cool? Is that full circle? Questions?
One thing that's nice about this, we have a long-term rental, and it's like the people were in 1 year, they were going to stay, and they decided we're not going to leave, but they are going to leave, so all of a sudden we've been having to find new tenants.
Yep.
This is like, you got
10 years, you sit there, hang out. Yep. And no property management either. So if they call you for your toilet, anything under $1,000, it's yours. Anything above $1,000, it's insurance. So, cool. Does that make sense?
I love this laugh. You get giddy about it. It's like a people film.
After you have somebody like fund this deal, are you still in the deal personally?
50
Or are you just getting the 10K?
50-50. Yep. I run it for the whole time.
Okay.
So you get to cash your check at home, and that's it.
So is that still the 20?
No, because we're splitting this at half. So we're at 10 at that point.
You're still at 10.
You're still at 10. Sorry.
He's at
I'm at infinite. Because I got paid to build cash flow for me and for them, right?
Okay, so I have a couple. So are
Sure.
you still managing, you're managing the deal? Right?
Yep.
You're collecting and you're paying your third party, whatever.
Yep.
Right? So you're still in the deal, you're managing it. Okay. How are you finding your tenant buyers?
Okay. Marketing. So flyers in the neighborhood, knocking on doors in the neighborhood. Do you have family and friends in the neighborhood? Like we want to get people from that neighborhood in that neighborhood because those are the people that they're already around the people they want to be around, right?
So is that happening fairly quickly then? You can find a tenant buyer that
6
has
weeks
that
ish. Yeah, at best. And it's already done. So 3%, 400 at 10.
That's their fee. The 3% is their.
3% is the appreciation.
Right. So they have a fee to actually for the option, right?
No, so I can't do the math on what 3% is at 10 years, but
I know that. So that's building in what you're going to. 3% on the 400,000 is going to be their purchase.
is the purchase price.
But do you have a fee for them to?
It's already here.
have the option?
Yeah, it's already here.
Oh, so I thought that
It's
was
already
the
no,
rental contract.
no, it's already built in. It's the lease contract because there is no rental contract, right? So it's already built in because it's above market rent and they have a higher down payment.
Gotcha.
Because for this scenario, I would say maybe 3,200 would be traditional market rent,
Okay.
or maybe 3,100. Usually we can go anywhere from $200 to $500 above market rent,
How do you determine if you want to go 5, like you said, 5, 7?
based on the neighborhood, based on the market, based on where they're at. Yeah,
Okay.
yeah. I think so. A lot of the questionable calls, we say goes to business common sense. What makes sense for the business for it to make sense?
Are you keeping that, you're never raising the rent of the mortgage?
So this is only day one. We are still raising rent. So yes, this is the bare minimum that we're pulling through. So we're not talking about raising the rent $150 per year or $75 for the next year, so on and so forth. So if we're adding that stuff up, we're killing the game over the 10-year long haul. Does that make sense?
Are you telling them that ahead of time? Because again, they're the owner, they're going to be the owner, so.
Yeah, it's an expected market variable. Yeah, 100%. If you've ever owned a home, if you've ever rented, you kind of know that market.
But when you get
Yeah, but it's in the contract. Yeah, it's still in the contract. It's still in the contract.
$75 increase
Yeah,
each year.
100%.
And then you can tell them about the percentage of people that actually execute on that rent and purchase. Because there are,
The actual lease option purchase. Yeah.
I mean, what is the percentage of that actually close? Because I hear a lot of people walk.
A lot of people do walk. But the whole goal that we want to set up, again, going back to integrity, is we want to build a scenario for them to win, right? And so even if it's the case of, hey, do we need to help fill out COVID paperwork at that point? Like, we'll try to find you money in that regard. But yeah, we'll try to do whatever we can to make sure that they win to an extent where it's not going back to like building and helping them build their credit. Like that's up to them at that point, right? But there are still a lot of people that do cash out because they've had 10 years to do that. Ideally, hopefully. Okay, so then let's take a look at what happens if it's the losing theory. What happens if they don't cash out?
You walk away with their 10 grand,
Or you can re-sign.
and you get to redo it.
I just do this all over again.
Yeah.
Yeah, that was it. So if they buy the house, I win. If they don't buy the house, I win.
Do you let them do it earlier if they want to?
Sure.
Yeah, like if they're like, oh my God, that's great, I'm 40.
Yeah, they won the lottery and they want to pay it off. Okay. Again, win-win-win scenarios, right? It doesn't hurt me at all.
What if they're in the house and they need to move across the country and no longer want to be renting the house?
Cool. Have a good day. Yeah, wish you the best. Yeah. Or, let's say going back to COVID situation, they can't pay for it anymore. Listen, I get it, right? It's hard for everybody. How about this? I'll give you $1,000 for you to move your family out of here and go get them to a nice, safe place that you can afford. Just give us the keys back and we're good. I don't want to evict you. I don't want to do any of that. Here's $1,000. Go take care of your family. Because I know you can't afford it, so I know you're not going to afford last month, and I know you can't afford next month. There's no point in keeping this pain point going. So here's $1,000. Go find your family a new spot. take care of yourself.
There's stuff that you're doing on MLS too, so you're getting.
Yeah, you can find them on the MLS. Yeah, absolutely. Yeah, absolutely. And it's easier on the MLS because they're ready.
Yeah, they're ready.
Yep.
And in this market, are you still doing all right with that?
Yeah, because the argument there is, have the rents gone up with the market? So we can't look at it one-sided, right?
Are you guys using a real estate agent?
Yep. Yep. And wholesalers and anybody else. If anybody else wants to sell me a house, I'm cool with it.
Do you have very specific neighborhoods that you're targeting?
Yeah, so we look at West Phoenix for the most part, just because that's been his.
Like Glendale?
Yeah, Glendale, Peoria, that's been his area of expertise. So we're like, I don't want to reinvent the wheel. Yeah, I started looking into Mesa a little bit, but even then, it's almost easier to just have like pounding those specific zip codes at one hit.
Apache Junction's really good for that too.
I saw Apache Junction too.
They are, yeah.
Yep, and it's growing out there
Oh yeah.
for sure. Right, Queen Creek is almost like, yeah, exactly. Now we're bumping up a little bit, and that'll be the difference. I want normal people in normal neighborhoods. If there's any running going on, I don't want it.
So you don't charge a fee for them to have the option.
Nope, it's already built in here.
Part of the deposit.
Yep,
Okay.
yep. And they're also paying that additional monthly.
Okay. So now, if they wanted to bank some down payment, they could pay additional into that you could then take off of.
I have no willing to do that because I want to. Those are two separate contracts,
Right.
so I'm not mixing the two at all.
Okay, so they can bank it themselves.
Yeah, if they want to pay me more money, okay. But yeah, otherwise, go keep it in the bank.
It's not gonna do any good.
Yeah. So what? But
Until when you can get your.
But what will happen is we do one showing. So how many agents in the room? Do you guys drive around your clients and show them houses? Okay. And are they already qualified already or whatever the case? Perfect, right? Same thing here. So these buyers are going to go through all the pre-qualification. They have one set time that all of the potential buyers are going to go to the house at one time with a check in hand, cashier's check in hand, right? And so sometimes it will be, you know what, I'm willing to give you $5,900 versus $4,900 if I can get the house over that family.
Bidding war.
Yeah, and because I'm just going to show the house once. Here's the time that I'll be there. If you want the house, this is the time you got to be there.
Easy qual, who does that?
We do that.
Okay.
I mean, third party credit check and background or whatever.
That's what I'm
Yeah,
saying.
yeah, yeah.
Because you're still giving that information.
Yep.
And still, I mean, yeah, it's been called sometimes that, that they have a job in the income.
Yeah,
tax
and we'll still
not
check.
credit or less.
Yeah, we'll still check their like previous landlords and stuff like that. We usually, even going back to 2 landlords ago, because what's their last landlord going to tell you? Like, yeah, they're great, only to get them out of where they're at, right? And so, yeah, so we'll still do those kind of due diligence aspects of it. Yeah, anything else? Is that? So keep in mind that this is only one pathway of revenue between all of it. Like, this is just one way of making money. We didn't go through the raises every year. We didn't go through appreciation. We didn't go through depreciation. We didn't go through tax benefits. We didn't go through any of that other stuff. And that just keeps adding on and on and on to this 21% number. So at the end of the day, this 21 might turn into 35 at that point. Cool? Was that it? All right. Any questions online? Are we okay?
I haven't seen anything else
Okay.
come through. Michelle Woker was making some comments about installment sales.
CPA, man, I'm not a tax guy. I just say, hey, yeah, this is what I got. Go do that. But there are, depreciation. What is it? Section 179A, 199A, or 179A and 199. Yeah, but that's not my language. Anything legal?
Not your love life?
No, anything legal and accountant wise? Nope, I don't want to deal with it.
Hey, we have a good guy though, so you can talk to him.
Perfect.
All right, you're awesome.
Cool.
All right.
Thanks, guys.
For sakes of live, I'm going to stop the feed, but you guys can obviously ask whatever you want.
Yeah.
And no one online heard that. All right, peace out, guys, online. My sister made it. Hi, Michelle. Michelle, so see, this was the only other question.
Yeah.
So let's see, can I scroll through? Installment contracts allowed in AZ?
I don't think installment
Dodd Fries?
contracts are.
But for like a general purchase,
yeah,
they should
I
be.
guess they should
Like
be,
for
yeah.
I just think mixing it with the lease.
That's where the question
That's the issue.
Yep.
Okay, so no. All right, that was it. That was the only thing online. Bye, Aura. Love you guys. Peace out. All right, we're gonna say